Hey there, short squeeze enthusiasts and market watchers. Welcome back to the channel where we dive deep into the fascinating world of hard to borrow stocks and the mechanics behind potential short squeezes. Today, we're spotlighting a microcap name that's generating some serious buzz on our screens. But first, a critical word. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about Lyoness Oil International Group Limited, trading under the ticker LHSW. This company, operating in the technology and software infrastructure sector, provides machine vision products and solutions in China. Their offerings include industrial machine vision, artificial intelligence products like face recognition and AI behavior analysis, and intelligent recurrent products. Currently, LHSW has a market capitalization of just $12.03 million, putting it firmly in the microcap category. Show company logo / stock chart. Looking at its recent price action, LHSW has seen quite a ride today. It's down 4.76%, but over the last 5 trading days, it surged an impressive 114.69%. Over the last 30 days, the stock is up 26.33%. Volume-wise, today saw 568,200 shares trade hands, which is significantly below its 30-day average volume of 4,078,947 shares, indicating a relative volume of about 0.1x average. What is cost to borrow and why it matters? Before we dive into why LHSW is on our radar, let's quickly explain one of the most crucial metrics for potential squeezes, the cost to borrow, or CTB. When you short a stock, you're borrowing shares and selling them, hoping to buy them back later at a lower price. But borrowing those shares isn't free. You pay an annualized fee to the lender. This cost to borrow is essentially the interest rate on the borrowed shares. When this fee skyrockets, it's a clear signal that shares are becoming incredibly scarce and difficult to borrow. A high CTB indicates strong demand from short sellers vying for a limited supply of shares, making it an expensive bet to stay short. And yes, these fees can easily exceed 100% annualized, sometimes reaching into the hundreds or even thousands of percent for truly hard to borrow names. Why the stock is hard to borrow right now? Now let's get specific with LHSW. This stock appeared on our hard to borrow screener for some truly eye-popping reasons. The current annualized cost to borrow fee for LHSW stands at an astonishing 720.7%. That's right, over 700% to hold a short position for a year. What's more, the CTB has seen incredible momentum, rocketing up by 728 percentage points over just the last 5 trading days. Highlight CTB number. This massive surge tells us that the difficulty in finding shares to short has intensified dramatically and very recently. Currently, there are only about 20,000 shares available to borrow against an estimated float of a mere 0.1 million shares. Our internal composite squeeze score, which combines factors like CTB level, CTB momentum, shrinking borrow supply, float size, volume/price momentum, and technical setup, gives LHSW a score of 70.9 out of 100. This combination of extremely high cost, rapid CTB increase, and critically low supply points to a market under significant stress for short sellers. Squeeze mechanics explained. So, what does all this mean in the context of a short squeeze? A short squeeze happens when the price of a heavily shorted stock begins to rise. As the stock climbs, short sellers, who are losing money, might be forced to buy back shares to close their positions and limit their losses. This covering creates buying pressure, which pushes the price even higher, forcing more short sellers to cover, creating a positive feedback loop. With LHSW's cost to borrow at 720.7% and only 20,000 shares available to borrow against such a small float, any significant upward price movement or increased demand could make it incredibly painful for short sellers, potentially forcing them to buy back shares at escalating prices. It's a game of chicken, where the high CTB increases the pressure every single day. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also simply mean that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to maintain their positions. Dilution risk check. When we're looking at squeeze candidates, dilution risk is a major factor. Dilution occurs when a company issues new shares, which increases the total share count and can offset buying pressure, effectively negating a squeeze thesis even if cost to borrow is high. For LHSW, our checks found no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B in the last 90 days. This is a positive sign as it removes a common hurdle for short squeeze plays. Recent reverse split watch. Another important detail for LHSW is its recent reverse stock split. The company executed a 1-for-16 reverse split on June 22, 2026, which was just 16 days ago. A reverse split reduces the number of outstanding shares and proportionately increases the share price. For instance, if you own 16 shares at $1 each, after a 1-for-16 reverse split, you'd own 1 share at $16. While reverse splits are often done by struggling companies to boost their stock price above the listing thresholds, we've observed a historical pattern where many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, sometimes attracting speculative interest due to the reset share price and reduced float. This is a pattern we've seen in some microcap names, not a guarantee or a rule, but it's an interesting contextual factor for LHSW's current situation. Let's take another moment for that important reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching for with LHSW? Keep a close eye on the cost to borrow. Is it sustaining its incredibly high level, or even rising further? Monitor the shares available to borrow. Any further decrease from the already low 20,000 shares could significantly amplify pressure. Watch the trading volume and price action. A sudden spike in volume accompanied by sustained upward price movement could signal increased buying pressure and potential covering. Remember, the core dynamic here is the extremely high cost for shorts to maintain their positions, coupled with a tiny float and very limited borrowable shares. Lyoness Oil International Group Limited, or LHSW, presents a fascinating case study in the hard-to-borrow landscape, driven by its astronomical 720.7% cost to borrow, extremely limited share supply, and the recent reverse stock split. While the dynamics are compelling, remember that investing in such volatile microcap stocks carries significant risk. This is purely for educational purposes to understand the mechanics of short squeeze indicators. If you found this deep dive into LHSW helpful, please hit that like button, subscribe for more unique short squeeze analyses, and let us know in the comments what stocks you'd like us to cover next. Thanks for watching and happy learning.